The committee will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time. Just for situational awareness for everybody, we are anticipating votes on the House floor sometime shortly after 3, maybe 3:15 or 3:30 in that area. This hearing is entitled the Jobs Act at 5, examining its impact and proposals to further enhance capital formation. I now recognize myself for 3 minutes to give an opening statement. While small companies are at the forefront of technological innovation and job creation, they often face significant obstacles in obtaining funding in the capital markets. These obstacles are often attributable to the one-size-fits-all securities regulations intended for large public companies place on small companies when they seek to go public. Signed into law on April 5 of 2012, the bipartisan Jumpstart Our Business Startups Act, popularly known as the Jobs Act, consists of 6 bills that originated here in the House Financial Services Committee to help small companies gain access to capital markets by lifting burdensome securities regulation. By helping small companies obtain funding, the Jobs Act has facilitated economic growth and job creation. Additionally, the Jobs Act has fundamentally changed how the Securities and Exchange Commission approaches securities regulation. The SEC Commissioner Michael Pivovar described how the Jobs Act has changed the SEC's mission this way, and I quote, "The Jobs Act requires the Commission to think of capital formation and investor protection in fundamentally different ways than we have in the past. The crowdfunding provision of the Jobs Act forces us to think outside of our historical securities regulation box and to create a different paradigm that one we have used for the past 8 decades." End quote. The Bipartisan Jobs Act was an attempt to remedy the SEC's inaction on capital formation, and even President Obama called the law a, quote, game changer for entrepreneurs and capital formation. Regrettably, though, the implementation of the Jobs Act by the SEC languished under the chairmanship of both Mayor Shapiro and Mary Jo White. By failing to fulfill its important part of its mandated mission, the SEC is hurting small businesses, impeding economic growth, and hindering the creation of new jobs. It's extremely troubling to me that the SEC seems more intent on pursuing highly politicized regulatory undertakings outside of its core mission. Instead of working to protect investors, maintain fair and orderly and efficient markets, as well as to helping to facilitate capital formation, the SEC has been more focused on exerting societal pressure on public companies to change their behavior through disclosure rules, such as the conflict minerals and pay ratio rules, et cetera. It's time to refocus the SEC to advance a broader capital formation agenda. Let's continue to build upon the successes of the Bipartisan Jobs Act by further modernizing our nation's securities regulatory structure to ensure a free flow of capital, job creation, and economic growth. It's time to get the federal government working to support innovation and reward hardworking Americans. And I yield back the balance of my time. Chair now recognizes the ranking member of the subcommittee, ranking member from New York, Ms. Maloney, for 3 minutes for an opening statement.
Thank you so much, Mr. Chairman. And I look forward to working with you this Congress, and I want to welcome everyone to the very first Capital Markets Subcommittee hearing of the year. The basic mission of the Jobs Act, and I'm proud to have been a sponsor of this bill, was to make it easier for companies to raise capital from investors, whether that capital was being raised in the public markets or the private markets. 2 of the main provisions of the Jobs Act have gone into effect in the past year and a half: Regulation A+ for small offerings and crowdfunding. Both of these provisions were designed to make it easier and less expensive for small startup companies to raise capital, and both provisions targeted small companies that may not have been able to raise capital using the traditional methods, like an IPO or a private placement to sophisticated investors. So this is a good time to step back and evaluate the progress of these 2 provisions by asking some simple questions. Are they working as intended? Are investors using them? Have they caused any investor protection problems? Are there any changes that need to be made to improve either of these provisions? The preliminary data suggests that both Reg A+ and crowdfunding are working broadly as intended, although there is some room for improvement. Both provisions are being used by very small startup companies. The typical company using both Reg A+ and crowdfunding only has 3 employees and has less than $5,000 in cash and no revenues. Crowdfunding is primarily being used by small companies that can't raise money any other way and only to raise a small amount of capital. The median amount raised using crowdfunding was only $171,000. Regulation A+, on the other hand, is being used by a wider range of companies, mostly very small startup companies, but also some larger ones as well. Most of the companies that use Reg A+ have also raised money by issuing private securities to sophisticated investors before, which indicates that Reg A+ is being used as a supplement to other offering methods. I am concerned, however, about the fact that FINRA has already had to terminate one crowdfunding portal for allowing several companies that appeared to be fraudulent from offering securities on its platform. This raises serious investor protection concerns that we have to keep in mind as we review the impact of the Jobs Act. I look forward to hearing from my colleagues and from all of the panelists, and I yield back. Thank you.
The chair now recognizes the gentleman, our vice chair of the subcommittee from Illinois, Mr. Hultgren, for 2 minutes for an opening statement.
Thank you for convening this hearing, Chairman Huizinga. Access to the capital markets and job creation is incredibly important to my district and to all of our districts, and we need to ensure U.S. capital markets remain a competitive means of financing. It's very fitting that review of the Jobs Act is our first subcommittee hearing topic in this subcommittee this Congress. Before speaking any further, I would be remiss to not mention how excited I am to be serving as the Vice Chairman of the Subcommittee on Capital Markets, Securities, and Investment this Congress. We have our work cut out for us, but I'm optimistic that we can advance policy that will allow our economy to recognize its true potential. Competitive capital markets are important to job creators in my state and also to those who work to provide this financing. There's a number of important financial services entities in the Chicago area that are instrumental to ensuring robust access to financing that make Illinois the home of Midwest finance. To the point of today's hearing, I know the Jobs Act has made a meaningful impact in Illinois and in my district, and I am eager to hear how Congress can do more. Understanding how difficult it is to operate as a public company really struck me the other day when discussing the reasons Michael Dell took his company private. This gave Dell, which had long operated as a public company, more flexibility to pursue what it determined to be best for its growth. I'm sure this statistic is going to be cited a number of times today, but we should not lose sight of it. The number of public companies today is about half what it was 20 years ago. We went from about 8,000 public companies in 1996 to some 4,400 public companies today. We need to learn more about why this is and how we can help change this trajectory. I believe it's important that job creators have both strong public and private financing options available. I look forward to the testimony today and to discussing some of the specific policy proposals mentioned in the written testimony, and I yield back.
Gentleman yields back, and the chair now recognizes the gentleman from Connecticut, Mr. Himes, for 2 minutes for an opening statement.
Thank you, Mr. Chairman, and thank you for holding this hearing. We rise and fall on our ability to innovate. Companies everywhere are creating new products and new services that could change the world, but we might not see the next Pinterest, Blue Apron, Snapchat, or Google if we don't make it easier for them to jump from upstart to established. Next month marks the 5th anniversary of President Obama signing the Jobs Act into law. The act is an excellent example, in my opinion, of how the federal government can support business and job growth in our nation by allowing fast-growing firms to launch an IPO when they're ready to do so and then scale up to the full regulatory responsibilities and expenses associated with being public. At the crux of the Jobs Act, of course, is the creation of an IPO on-ramp, which makes it easier for small to medium-sized companies to undertake an IPO and creates a new category of emerging growth companies that would enjoy certain regulatory exemptions as a result of that status. EGCs now apparently dominate the IPO market, accounting for almost 90% of IPOs that have gone effective since the Job Act was enacted in April of 2012. The online travel site Kayak, headquartered in my district, was able to go public in 2012 thanks to the Jobs Act as an EGC. I'm proud of the bipartisan manner in which the Jobs Act came into existence. It really serves as a model for how Republicans and Democrats can work together to help advance one of the primary American competitive advantages, which is good liquid capital markets. I do have one question which I hope the panel will address. In life, there's rarely such a thing as a free lunch, and obviously every time we lighten regulations, there is always the possibility, maybe even the probability, that you've got more scope for abuse, bad behavior, and bad outcomes. So I hope we do here, as much as we celebrate this act and what it has allowed some companies to do, whether we've seen any downside or bad outcomes associated with this act. But nonetheless, this is proof of the progress we can make on behalf of the American people when we work together, and I hope that we won't have to wait another 5 years to see similar successes. With that, I yield back the balance of my time.
The gentleman's time has expired. Today, we welcome the testimony of Mr. Raymond Keating, who is the Chief Economist of the Small Business and Entrepreneurship Council. We will also welcome Brian Hahn, who is the Chief Financial Officer of Glycometrics. Is that correct? All right. Incorporated. And then Andy Green, Managing Director of Economic Policy at the Center for American Progress. Mr. Edward Knight, Executive Vice President and General Counsel of NASDAQ in New York, and Thomas Quadman, Vice President of the U.S. Chamber of Commerce, who is here. And so, gentlemen, we welcome you all, and you'll each be recognized for 5 minutes to give an oral presentation of your testimony. As we had said, we are going to be a little pressed for time for some votes. So feel free to shorten it up if you can, or if you are interested. We do want to make sure we're able to get to some questions. So with that, Mr. Keating.
Mr. Chairman, I am from New York, so I'll talk fast. Mr. Chairman, Ranking Member Maloney, and members of the committee, thank you for hosting this important hearing today on the Jobs Act and the competitiveness of U.S. capital markets. I'm Raymond Keating, Chief Economist for the Small Business and Entrepreneurship Council. We're a nonpartisan, nonprofit advocacy, research, and training organization dedicated to protecting small business and promoting entrepreneurship. Gaining access to financial capital is essential to the creation and growth of businesses. At the same time, access to capital remains a major challenge for entrepreneurs starting up and building enterprises. In my written testimony, I present data on the recent trends in bank small business loans, angel investment, and venture capital investment. To sum up, the value and number of traditional small business loans are still down from pre-recession levels. Angel investment also remains down from its 2008 level, while also experiencing stagnation over the last 2 years. In addition, venture capital has really shown the most life post-recession, but a decline in 2016 is certainly troubling. So what's going on? First, it's about reduced levels of entrepreneurship. We did a study in August on examining levels of entrepreneurship in the economy. We looked at an assortment of data and all pointed to declining levels of entrepreneurship. The mid-range of these data points looked at, we estimated about 3.7 million missing U.S. businesses in 2015 compared to where we were at previous times. Reduced levels of entrepreneurial activity naturally mean reduced loan and investment demand. Number two is these loans and investment trends again speak to the struggles of entrepreneurs to gain access to the financial resources needed to start up and grow. Why does this matter? We all know, I think, the answer to that. Quite simply, entrepreneurship is the engine of innovation, productivity, and income growth, and job creation. And in turn, entrepreneurship depends on the willingness and ability of investors and lenders to supply investment and credit. During the current recovery expansion period, the U.S. economy has grown at half the rate it should, and that's largely been about poor private investment growth. So providing small businesses with more options or avenues to expand access to financial capital is a clear positive. Two important parts of the Jobs Act focused on opening up new avenues for individuals to invest in entrepreneurial ventures, such as via crowdfunding. Title II of the Jobs Act was about accredited investor crowdfunding, and Title III, crowdfunding for everyone else, if you will. As for the investment under Title II, according to Crowdnetics report, a recent Crowdnetics report, the number of new offerings actually declined over years 1 to 3, but capital commitments at the same time rose substantially. Meanwhile, according to Crowdfund Capital Advisors, since Title III launched in May 2016, capital commitments registered almost $30 million as of March 10th of 2017. Even given the positive changes, areas in need of improvement always exist, including government placing too many limits on the ability of entrepreneurs to gain access to capital and/or on investors' abilities to make investments in entrepreneurial ventures. For example, crowdfunding opportunities should be expanded for businesses of different sizes and stages, and therefore the limit of raising $1 million during a 12-month period under Title III, crowdfunding should be raised, for example, to $5 million. Jason Bess and Sherwood Neese of Crowdfund Capital Advisors have pointed out that 2.2 jobs are created within the first 90 days after a company is successful with a securities crowdfunding campaign. So we very much see job creation happening. Also, the ability of investors to invest should be expanded. In addition, it should be clarified that funding portals cannot be held liable for material misstatements and omissions by issuers unless portals are guilty of fraud or negligence. This assurance would reduce unnecessary risks for crowdfunding portals. In conclusion, U.S. capital markets are the envy of much of the world, but we must be vigilant in making sure that while regulatory policy protects against fraud and abuse, it also reflects the reality that free markets provide the foundation upon which entrepreneurship, investment, innovation, and business can flourish, thereby providing a breathtaking array of goods and services and jobs that improve all of our lives. Financial regulation must recognize these realities, recognize the transparency that technology has imposed upon the system, and be built on a respect for free enterprise. Thank you for your time, and I look forward to the discussion and questions.
Thank you, Mr. Keating. With that, Mr. Hahn, you are recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Maloney. As the CFO of a company that benefited from the Jobs Act, I would like to personally thank the subcommittee for its hard work as we celebrate the law's 5-year anniversary. The Jobs Act was a game changer for biotechs like mine because it increases the capital formation potential of an IPO and decreases the capital diverted from science to compliance. 212 biotechs have gone public under the Jobs Act, a 4-fold increase from the 5 years before Jobs. Since our IPO, we have nearly doubled our employee headcount, and we have moved 2 additional new drug candidates into human clinical trials. These 212 innovators are seeking treatments for a wide range of devastating diseases. At Glycomimetics, we are working toward therapies for patients suffering with sickle cell disease, acute myeloid leukemia, and multiple myeloma. Under the Jobs Act, the industry has seen a surge in IPOs for diseases that were previously difficult to finance, including diabetes and Alzheimer's. We have also seen a dramatic increase in early-stage financing. There were just 3 early-stage IPOs in the 5 years before Jobs, but since Jobs was enacted, there have been 48. The Jobs Act's testing the waters and confidential filing provisions were vital to the success of our IPO, and we continue to benefit from the 5 years of reduced compliance with costly burdens like SOX 404B. In short, the Jobs Act has changed the game for finance and therapeutic innovations. Jobs Act's biotechs have 696 therapies currently in development, and the FDA has approved 18 new treatments from Jobs Act companies. I'm excited that the subcommittee continues to consider ways to build on the success of the Jobs Acts. Many of the capital formation provisions for the Financial Choice Act would further support the growth of small public biotechs. In particular, I strongly support the Fostering Innovation Act introduced by Representatives Sinema and Hollingsworth. The Jobs Act 5-year SOX exemption has saved millions of dollars for growing biotechs, but most will still be pre-revenue when the IPO on-ramp expires. Glycomimetics expects our annual expenses to increase by upwards of $350,000 starting in year 6 on the market, capital that could treat over a dozen patients in the clinic. The Fostering Innovation Act would extend the Jobs Act exemption for pre-revenue companies. This bipartisan bill recognizes that a low-revenue company that has been on the market beyond the 5-year EGC window is still very much an emerging, growing business. The continued cost savings in the bill are vital because every dollar spent on a one-size-fits-all burden is a dollar diverted from the labs. I also support Congressman Duffy's Corporate Governance Reform and Transparency Act. Proxy advisory firms' outsized influence on emerging companies has proven to be uniquely damaging to growing biotechs, to say nothing of the firm's conflict of interest and opaque standard-setting processes. Mr. Duffy's bill to regulate proxy firms would be a welcome change from the status quo that forces companies to contort themselves to satisfy proxy advisors rather than making decisions in the best interest of the companies and its shareholders. These important bills and other capital formation provisions in the Choice Act, like cost savings from XBRL and SOX, will build on the Jobs Act by supporting the growth of the 212 newly public biotechs that have enjoyed its success over the last 5 years. The Jobs Act has shown the strong impact of policymaking drive toward capital formation and away from one-size-fits-all regulatory burdens can have. I applaud the subcommittee for considering further initiatives to support small business innovators, and I look forward to answering any questions you may have.
Thank you very much. Mr. Green, you are recognized for up to 5 minutes.
Thank you, Mr. Chairman and Ranking Member Maloney, for the opportunity to testify on this important topic. I'd like to make 3 points overall. First, the impact of the Jobs Act has been mixed, although many results are not in. For the public markets, regulation is not the problem. Rather, a focus on structural issues such as competition would be very helpful. And then for the private market, small business access to capital impacts have also been mixed, and investor risks remain. A new focus on the wealth, skills, and network gaps for would-be entrepreneurs is needed. One of the principal goals of the Jobs Act was to increase IPOs. For better or worse, the IPO market is now dominated by EGC companies. But being an EGC company has nothing to do with any particular nature of the company itself, whether innovative, exciting, not exciting. It's just a regulatory label. Unfortunately, data suggests that these EGCs tend to be lower in quality from a listing and investment perspective. 46% of EGCs that filed a management report on internal controls reported material weaknesses in those controls. One study found EGC companies had a 21.8% lower return on assets and 3% lower stock performance on average. Capital formation and market liquidity for these stocks also appears negatively affected. And another study found that EGCs experienced 7% more underpricing than similarly sized companies prior to the Jobs Act. Another study was more positive about the Jobs Act effects on IPOs. It found a 25% increase in IPO volume compared to the 2001 to 2011 levels. But this was largely due to the confidentiality and test-the-water provisions that de-risked the offerings in terms of their outward-facing communications with investors. The deburdening provisions, such as reduced disclosure, lighter accounting rules, were not meaningful. And this is an important conclusion because it shows that most provisions that reduced investor protection were not important in terms of increasing IPO availability. The study also found little evidence of improved analyst coverage despite the reductions in investor protections on conflicts of interest provisions. Unfortunately, this good news did not last. In 2015 and 16, IPO volume fell to the lowest level since the Great Recession. I'm not pleased to note this. It just notes that I would just highlight that other factors, other than compliance requirements, may have a much stronger influence on IPO behavior. So the question then is whether the lighter compliance requirements of Title I make sense. It appears that the confidentiality and test-the-water provisions seem like good ideas, seem to be working, and seem to have limited negative consequence, so let's keep them. It may make sense to revisit some of the deburdening provisions, at least by giving the SEC more flexibility to restore those that were removed by statute, given the somewhat lower quality results in the EGC companies. If Congress wished to boost the viability of the public markets overall, it needs to turn its attention to other factors. One I would particularly like to highlight is competition policy. Mergers and acquisitions are now the biggest reason for the market decline in listed companies, and there's growing evidence of market concentration across the economy. Stronger approaches to antitrust enforcement are needed. The SEC may have a role to play as well. The Exchange Act, Section 23A, mandates the SEC considers competition as part of its rulemakings. Competition is sprinkled throughout the federal securities laws as an idea. It's even part of the title of this hearing. And the SEC has a number of tools to boost transparency, better regulate M&A, and help level the playing field back towards the public markets. I don't have specific recommendations today, but I think it's a topic that I would encourage all of us to think about more as we think about holistically how to boost our public markets. Let me briefly say a word about our private market provisions of the Jobs Act. First, old Rule 506B is still working very well. The market more than doubled from 2009 to 2014 in terms of the amounts raised annually. The Title II provisions of 506C are not widely used. So 506C is really the workhorse, and that's still a success. New provisions, such as Title II crowdfunding, appear to be working well, and we're in the early stages of Title III and state-based crowdfunding, not part of the Jobs Act, but part of the spirit of it. And I look forward to seeing the results as companies take advantage of it and it goes well. Risks are yet to manifest, and we still need to be very careful about those. I remain deeply concerned about the broader reach of general solicitation. Even though most companies are not taking advantage of it, it is still used. And when there are problems, investors don't get all their money back, and the SEC does not have enough resources to track down everything after the fact. That's why stricter requirements for filing Form D make a lot of sense. Lastly, I'd like to encourage a focus on the wealth, training, and network gaps that would make a lot of difference in terms of enabling entrepreneurs from minority and women-headed households to have more opportunities to access the capital markets. There's a lot more I could say, and I look forward to taking questions. Thank you very much.
Thank you. With that, Mr. Knight, you are recognized for 5 minutes.
Thank you very much for inviting us here today. I want to highlight a few elements of my testimony. I've been general counsel at NASDAQ now for 17 years. I've seen the markets evolve a lot. One of the most consequential acts of Congress in that period has been the Jobs Act. It has been positive for both the public markets and the private markets. But I want to say out front that NASDAQ believes in regulation. We do a lot of regulation at NASDAQ. It's important to protect investors. We looked at 46,000 SEC filings last year. We delisted 68 companies. We did background checks on 4,100 directors and officers before we allowed them to list. But there is no doubt that listing on a public market does have a positive impact in terms of, for instance, jobs creation. I think there's just irrefutable evidence that jobs get created once companies go public. Most public companies grow by 100% to 150% in terms of their employment. In the last 5 years, NASDAQ has taken 621 companies public. They have a market cap of $850 billion. They raised about $100 billion in new capital in doing that, and it's had a huge impact, we think a positive impact on the economy. The Jobs Act helped with that. I want to summarize what we see as the effects of it. As others have said, the ability to file confidentially, the ability to test waters, those provisions helped immensely, particularly with companies that were on the edge of going public. It pushed them to do it. Many in the healthcare area did it. And we've seen, I think, no adverse impact on investors because of these provisions. All we have seen is more entrepreneurship, more job growth, and I think a very positive impact. But it petered out after a while, as the chart will show you, I think the number 2 chart in my prepared testimony, how in the last few years the number of companies going public has gone down. And there are things that can be done to restore the vibrancy of these markets, to create an ecosystem that will be more conducive to companies going public, and I want to touch upon that. I do want to note that at the same time, while the U.S. markets have been dropping in terms of IPOs, other markets that we run in Northern Europe, for instance, are having a vibrant IPO market. So these things do react to public policy. This is not necessarily something that has to happen. I do also want to point out, even when the government doesn't regulate, these markets regulate themselves in the sense that major market participants, institutions, require of these companies a lot. It is not for everyone to go public. Not only is there regulation by the federal and state governments, but large institutions require a lot of these companies. And it's not for everyone, but what we're hearing over and over again from companies who are thinking about it, it's not necessarily going private. It's the process of staying private and what they have to accept in terms of regulation that may not be directly related to running a company. In a highly competitive global marketplace, distraction from the job of running that company and competing around the world is a cost that these companies pay. And you have to ask yourself, is this regulation really necessary for the running of this company, building these companies, creating opportunity, creating jobs, and creating innovation? Another key aspect of a public company that gets lost sometimes in the debate is when these companies go public, they are open to investment by individual investors. You do not have to be an accredited investor as you have to be in the private market. In my testimony, you'll see one of the most dramatic examples, Amazon, who went from the 1990s with a market cap of $350 million to a market cap of over $350 billion, employing hundreds of thousands of people. In the last year alone, they've created 100,000 jobs. What we think should happen more often is early-stage companies having the opportunity to go public, having a market that is more inviting than it is today, so that they will go public and grow in the public markets, not only to create those jobs, but also to give the investing public an opportunity to grow with them, which they do not always have today. So there are a number of things we would focus on. One is the Main Street Growth Act that Congressman Garrett introduced last year. That's been part of the Choice Act. We think that's positive legislation. The proxy reform legislation and modernizing disclosure in our markets. But we can get more into that. Thank you very much.
All right, thank you, Mr. Knight. With that, Mr. Quadman, you're recognized for 5 minutes.
Thank you, Chairman Huizenga, Ranking Member Maloney, members of the subcommittee. The Chamber appreciates the continued work of this subcommittee on capital formation legislation, including recent efforts with the FAST Act legislation to create the Small Business Advocate in the SEC, as well as the Poliquin legislation that forces the SEC either to modernize regulations or to explain why not. Yesterday, the Chamber, in conjunction with RSM, launched our quarterly middle market survey. And next week, in conjunction with Morning Consult, we're going to release our small business survey. Both of these surveys find that while economic challenges still exist, there is increased optimism amongst middle market and small business companies. However, that optimism is coupled with an expectation for Washington to remove barriers to growth. We need to have a balanced private and public capital market system in order to support our diverse economy. The Jobs Act was a bipartisan and helpful way of trying to address those imbalances, and it provided rules that would allow businesses to grow from small to large, make the IPO process easier, and for have companies to go public and remain public. There are initial successes with the Jobs Act, but the progress has been halting, and in some ways the situation is worse today than it was in 2012. More must be done, and SEC implementation issues have also harmed and blunted the effectiveness of the Jobs Act. The public company markets are in worse shape today than they were 5 years ago. As Mr. Holmgren mentioned, we have less than half the public companies today than we did in 1996, and that number has gone down 19 of the last 20 years. But let's take a look at 1982. Since 1982, the population of the United States has grown by 40%, our real GDP has increased by 160%, and we have roughly the same number of public companies today as we did in 1982. To put it in other words, the gains of the Reagan administration and the Clinton administration have been wiped out. There are four main drivers of this problem. One is structural and managerial issues at the SEC. We've issued 3 separate reports on that with 70 recommendations. I'm not going to get into that today. Financing issues, regulatory obstacles, and a 1930s-style disclosure regime that is increasingly used to embarrass businesses and not provide decision-useful information to investors. Combined, these issues create a tax on innovation and growth. And if we take a look at those numbers of public companies, as Justice Marshall observed 200 years ago, that power to tax is a power to destroy. We need to restore an ecosystem of growth that provides benefits throughout the economy. The Kauffman Institute did a study that showed that IPOs between 1996 and 2010 created 2.2 million jobs. Boosting growth from 2 to 3% takes 12 years off of the length of time needed to double the economy, reduces the deficit by $3 trillion over 10 years. A 0.5% uptick in growth creates 1.2 million jobs and $4,200 in additional income for workers. We need to recreate that culture that rewards success and celebrate when a UPS driver or a Microsoft executive assistant becomes a millionaire when their company goes public. In order to rebalance the system and reverse this trend, we think the SEC and Congress should do the following. Disclosure effectiveness needs to be a top priority. We shouldn't talk about it any longer. The SEC needs to move forward and bring a disclosure regime into the 21st century. We need to pass proxy advisory form legislation that creates transparency, accountability, and oversight over proxy advisory firms. We need to recognize that capital formation and corporate governance are inextricably linked and have 14A8 reforms, including resubmission thresholds, overturning the Whole Foods decision so the SEC was a fair umpire in the shareholder process, ownership verification so that we know that a shareholder proposal proponent actually owns shares in the company that they're proposing, making proposals in, and Reg D clarification to make the Jobs Act effective. We need to fix financing through the passage of BDC legislation, fixing crowdfunding, the Main Street Growth Act, as well as providing micro-offering safe harbors. We need to modernize rules, including expanding the eligibility for Form S3, clarifying the definition of accredited investors, exempting emerging growth companies from XBRL, and simplifying small private equity disclosure and registration. And we should also pass those remaining provisions of Title 10 of the Choice Act. These are, we think, very simple, common sense reforms. We think that others can be done as well, and look forward to taking your questions.
Thank you for that. At this time, the chair will recognize himself for 5 minutes for some questions. Mr. Quadman, while we were having this discussion, you note that I think the average initial regulatory cost associated with an IPO is $2.5 million, and the estimated annual compliance cost for public companies averages about $1.5 million. What are the main drivers of these costs?
A lot of the costs that are associated with that are legal costs. And it's also a matter of being able to go out and talk it to investors and the like. The Jobs Act actually did a lot to help facilitate that. However, with every IPO, there's a securities class action waiting to happen. And so the legal costs are actually high, and that company is also going to be expected to be sued. So I would even say that the costs are even more than that, but the regulatory costs are in that ballpark.
And the significant portion of these costs, are they relevant to all publicly traded companies, regardless of size? Or some of them hit sort of disproportionately?
So what the Jobs Act did that was very beneficial is that you allow emerging growth companies to ease into the regulatory process. As you are a public company for a longer period of time, those costs are going to go up, and they're going to go up dramatically because you're going to start to deal with different rules such as conflict minerals or whatever, which impose very expensive reporting regimes on companies. And that's actually the reason why Michael Dell said he was no longer going to run a public company, because he felt he would rather manage a company than having to deal with those extraneous issues.
Okay. Well, Mr. Knight, you testified that you had a number of discussions with CEOs, and that the primary challenge is not about going public, but about being public. It sounds like that's a consistent thing that you're hearing. Why is that? Can you elaborate on that a little bit?
Well, I'll give you a statistic. If you ask a Silicon Valley accomplished lawyer who takes companies public a few years ago what the rule of thumb was in terms of revenues for a company before they go public, they'd say $30 million. Today, they'd say $100 million. The infrastructure that you need in order to support all the reporting requirements and the regulatory requirements. I'm not talking about the financial disclosure. No one is arguing about financial disclosure. That is a key to a well-run market and protecting investors. It is the other public policy goals that have been put on the public company model that makes the market look uninviting, particularly at a time when
Put on
you've
by
got
whom?
by a CEO or a board that's considering options.
Okay.
Shall we go public? Shall we be acquired? If we get acquired, maybe some of the R&D we're doing is going to be thrown overboard, and the innovation in that company by the acquired company, the opportunity for investors to invest in that company through an IPO will be lost. The environment does not look very inviting, particularly when you have $8 trillion in sovereign wealth funds available to invest in these companies as private companies.
To interrupt here just a moment, but on your chart 1, that did strike me, showing that it's on page 2 for anyone who wants to take a look at it here. But you talk about the sovereign wealth funds and private equity firms and how they are the ones now capturing all that initial growth rather than the public who would be investing on that. And you kindly included 2 companies from my district, Macatawa Bank and Herman Miller, that that have had that, and they've had challenges, and stock prices are going up and down.
And
But elaborate on that a little bit.
There's nothing wrong with this. I mean, it is, the private market is vibrant. That's great. It gives people funding choices they might not otherwise have, but it won't always be. And the public markets need to be there, and they need to be there in a modern way. Many of the issues we're talking about on this panel are regulatory issues that haven't been revisited in 20 years. We're not talking about getting rid of them. We're talking about modernizing them. We're not talking about getting rid of disclosure. We're talking about bringing it into the 21st century where there is electronic disclosure. Why do you have to file with the SEC? I mean, that's an 18th century concept. You can provide it a website. You can put it on a website. You can use other electronic means of communication. And modernizing these markets will make them more competitive with other markets at the same time.
Well, I've run out of time, but that was going to be one of my last questions, is what specifically can Congress do to alleviate some of those crippling burdens, and for you and for Mr. Keating and others, but hopefully someone will be able to get to that. So with that, the chair recognizes the ranking member for 5 minutes.
Mr. Green, I'd like to ask you about crowdfunding. As you know, the crowdfunding rules have been in place since last May. The SEC recently did a study of it and found that it was broadly working as intended, but noted that one funding portal had been terminated by FINRA for failing to supervise several potentially fraudulent companies that were trying to raise money on their platform. What is your take on how crowdfunding has gone so far? Is it helping small companies get access to capital like we intended? And are you concerned that one of the intermediaries that Congress intended to reduce the risk of fraud has already been shut down? What is your take on all of this?
Thank you for that question. I think it's going well. I think that it's only been a short period of time, and the uptick is increasing, and we need to let the market mature. I'm actually pleased to hear about this enforcement action because it shows that our regulators are on the beat. And one of the most important things to make crowdfunding be successful is that investors have confidence that when they go to the market, they're going to have opportunities to pick from reliable companies via reliable intermediaries, funding portals, and other broker-dealers that are running portals. So actually shutting down a portal that's not doing their job makes me think that things are on the right track.
Okay, great. Do everybody agree, sort of? Any other takes on it that they'd like to add from any of the panelists on crowdfunding? Well, then I'll go to Tom Quadman. I noted in my opening statement that the new Reg A+ has been used by a wide range of companies. Some are extremely small, 2 or 3 employees. Some are much larger. I found it very interesting that many of the community banks have chosen to raise money through Reg A+, even though they can raise capital in other ways, such as private placement to sophisticated investors. Was this the target market? Do you think it's a problem that companies that can already raise money in other ways have been using Reg A+ to raise capital?
Well, I think what the Jobs Act did is tried to create as many different options as possible for businesses to raise capital. So if they could do it through Reg A+, if they were eligible for it, fine. If there are other ways to do it, that's fine too. One of the things that Reg A+ does is it creates a system whereby a smaller company can raise capital from a known investor base, which is why you also don't see the testing of waters as you do in other places. And it would make sense actually for community banks to use that, because as a smaller bank in a smaller community, they're going to know that investor base a lot better, and they're going to be able to use that as a device to try and raise capital from them, as well as the fact that there may be other costs involved with other systems that they may not have with Reg A+.
Well, you mentioned the testing of the waters. The vast majority of companies that have used Reg A+ so far have not taken
Correct.
advantage of this testing the waters option. So what do you make of this? Is testing the waters with potential investors just not that important for companies, or is it too difficult and time-consuming to go through the testing the waters process What is your take on all of that?
No, I think it's a very important device to use, and we're also, you could look at it in one context in terms of Reg D, general solicitation, or Reg A plus, and I think with Reg A plus, again, you're dealing with sometimes companies that are existing already that have a known investor base that they can go after. Obviously, you want to use testing of the waters when you're talking about a newer company that doesn't have that known investor base. So I think it actually, being able to do it both ways, satisfies the needs of companies at different parts of a maturity scale.
I'd like to go back to Mr. Green. On the current SEC rules require issuers using Rule 506 to offer private securities to file a form called Form D with the SEC only 15 days after the first sale. In addition, there's no penalty or disqualification for failure to file Form D. The SEC proposed to change these rules in 2013 when it implemented Title II of the Jobs Act to lift the ban on general solicitation. Do you think these safeguards are important for securities offered under the new Rule 506C?
I do think they're quite important. They're important for a number of reasons. One is baseline data collection. We don't have a great deal of insight across the entire Reg D market. So having a full compliance with the Reg D, the Form D filing would be very helpful. Another, but the more important aspect really is investor protection. As we move more towards making the private markets quasi-public by having public advertising, which is what general solicitation is, we need to be a lot more concerned about the impacts on ordinary investors who, are liable to make bad decisions and be taken advantage of. And there's a very interesting study that the AARP put out only a couple of days ago that I would highlight everyone to take a look at. It's got some amazing statistics.
My time has expired. Thank you.
With that, the chair recognizes our vice chair, Mr. Holcomb, for 5 minutes.
Thank you, Mr. Chairman. Again, thank you all for being here. I really appreciate your valuable insight and testimony here today. Mr. Hahn, wanted to see if I could start with you. I was drawn to this line in your testimony. You said the Jobs Act has been an unqualified success, enhancing capital formation and allowing companies to focus on science rather than compliance. I'm also a member of our House Science Committee, and I'm keenly aware of the innovative work that BIO and its members are doing. Wondered if you could provide some insight into how access to the capital markets is driving changes in medicine. We're really talking about making lives better, saving lives. I wonder if you could just give a little insight into that.
Thank you. As I stated in my testimony, the testing the waters provision of the Jobs Act was instrumental in our successful IPO. So at Glycomimetics, it's a very novel, unique approach that we're taking that takes a very sophisticated approach that, a single meeting with an investor before the Jobs Act in a 2-week IPO roadshow, investors could not get comfortable with the science and the technology, and testing the waters allowed enough time leading up the months before the IPO to actually get their head around the technology and the science, ask follow-up questions, and that was instrumental in helping a successful IPO.
That's great, thanks. Mr. Knight, thanks for being here.
Thank you.
And wanted to follow up on your testimony. In your testimony, you mentioned the idea of permitting companies of all sizes to file for their IPOs with the SEC on a confidential basis and permit other types of registration statements besides IPOs to be initially submitted on a confidential basis. I wonder if you could explain the benefits of filing under a confidential basis and what other type of registration statements you believe that this might be able to be extended to.
Yeah, I think it's important to understand when companies are considering going IPO, they're also looking at other options. And they want to be able to explore the option of going public while looking at these other options. If you have to file in the public, you are committing yourself in the sense that if you don't do it, the market will exact a price on you for having, quote, failed. So they don't want to fail at that. They want to explore it. Two is these companies, like all companies, are dealing in a very competitive marketplace, and these filings often have information that has a proprietary impact, and it is required. The public needs to know what your strategic plans are before they invest, but you're putting them out for all your competitors to see. So to have the optionality of deciding not to go public but perfecting your disclosure is very valuable to companies that are looking at this.
Mr. Knight, continuing with you, you mentioned briefly in your testimony about this, but wanted just to drill in a little bit further. As you're aware, former Chairman Garrett of the subcommittee sponsored legislation that would permit for exchanges to list venture securities. Do you believe such an exchange would improve liquidity and price discovery for these securities? And wondered if you could explain how intelligent tick sizes would improve liquidity for these securities, and also, I guess, do you have any other feedback on tick size pilot currently underway?
The tick size pilot, our current assessment is it's frankly too early. It does look like there's more liquidity that is being generated, but it's too early to make conclusions. People are still adjusting to it. But Congressman Garrett's bill had a number of what we think are very important features. The market structure that secondary trading occurs in has a cost associated with it. And we have a structure today that is designed to facilitate trading of Google and Amazon, which is great, but it doesn't work for smaller cap companies. And there needs to be an examination of that. To have a small cap company trade across 11 stock exchanges in 40 dark pools fragments that liquidity, it undermines the price discovery process. So the Garrett bill would allow the company that lists to decide to aggregate that liquidity on one market. It would allow the exchange to adjust the tick size to encourage liquidity by having wider tick sizes, bringing more market makers into it. I like to point out the Saudi Arabian stock exchange that we sell technology to, it has intelligent tick sizes. We don't have it here. We petitioned the SEC to consider it. We've not ever gotten a response. So we think it is an intelligent idea, and we're glad it was in that bill.
Thank you all. I'll yield back.
Gentleman's time has expired. With that, the chair recognizes Mr. Lynch for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I would ask unanimous consent that we could enter into the record a statement written by Mike Rothman, who's the president of the North America Securities Administration Association, Incorporated, and also a communication to the committee from the Council of Institutional Investors.
Without objection.
Thank the chairman. I want to thank all of the witnesses here today for your help. Very important. And Mr. Knight, I want to thank NASDAQ for its help on the tick size experiment, and I'm eager to hear what the data might show. Mr. Green, last Congress, the Chairman's Financial Choice Act, which seeks to expand some of the exemptions that we included in the Jobs Act. It also increases the penalties that the SEC might levy against some bad actors, but in an important way, it imposed significant requirements on the Commission prior to bringing an enforcement action. For example, the bill would require the Commission to conduct a cost-benefit analysis of whether the penalty would negatively affect shareholders of the company of which we believe their officers and employees may have broken the law. In addition, the Financial Choice Act would permit defendants to choose their own venue, which I have a problem with. And it actually creates an ombudsman to separately defend these bad actors before the Commission. And there are several other opportunities in the bill to slow down the enforcement process. So how would provisions like these that make it more difficult for the SEC to hold wrongdoers accountable harm the integrity of our markets and the company's ability to raise capital? And does this framework that's being suggested here in the Financial Choice Act, does this create a moral hazard where it's so hard to hold the bad actors accountable? People say, why not?
Congressman, I 100% agree that it creates a very serious moral hazard. I think that there's a lot more that needs to be done to improve the SEC's enforcement ability and its scope, but it's not going in the direction of tying their hands and making it harder for them to bring cases. I think there's been 20 to 30 years of accumulated Supreme Court and other precedents that make it hard for them to go after anybody other than the immediate speaker, and a bunch of other cases makes it hard for private attorneys general to bring cases. And all those things that you're talking about, being able to choose your forum, doing cost-benefit analysis, not actually holding the shareholders accountable for the decisions that their board and their executives make with their money, those are all completely the wrong direction. I'd also highlight one more part of the Choice Act that gives me great concern, is getting rid of the bad actor automatic disqualifications.
Right.
These are forward-looking, prophylactic things that improve investor confidence in our markets, and I think we have to come back to that. That's the strength of our markets, is investor confidence.
But you'd be hard-pressed to find an example of the SEC actually enforces the bad actor provision. I mean, case after case after case after case, they don't enforce that. Even when we've got, a successful enforcement action, and I had this issue with Sheila Bair and other folks there, that gave rise to this too big to jail accusation and a lot of criticism at the SEC. Let me ask you as well, while we're on this, the Choice Act would also allow emerging growth companies to be exempt from Section 404B, which I know a lot of people hate this, but it does introduce some accountability where the CFO has to sign off on the internal controls, audit. And I'd like to have your thoughts on that.
I think the evidence from the data is that the EGCs that don't have to do this have much weaker internal controls and are lower performing, and there's greater investor risk. So I think expanding that is the absolutely wrong way to go. I think holding people accountable, and that's the point of capitalism. Your money's on the line. You're the board. You're the CEO. You ought to sign on the dotted line and take responsibility.
Mr. Knight, if there were one recommendation that you'd like to make this committee aware of in order to increase the number of companies going public and creating the jobs, and I appreciate the work that NASDAQ has done on this, what would that one suggestion be?
Part of the difficulty in answering that is the problem is death by 1,000 cuts.
Yeah, okay.
It's not one issue.
All right.
Two is, I'll get back to the 404B issue, if I could respond to that also. Our experience has been that companies going public are not taking advantage of that. Why? Because there's a private ordering that is going along here. The institutions do not like you not doing 404B. So even though Congress may not require it, Fidelity may not invest unless you do it.
Yeah, that's a good point.
So you have to keep that factor in mind also.
Yeah, so it's positive peer pressure as opposed to...
Well, it's the investing
gentleman's time has
community.
expired.
I'm sorry.
It imposes a discipline.
I thank your indulgence, Mr. Chairman. I yield back.
The chair now recognizes the gentleman from Arkansas, Mr. Hill, for 5 minutes.
I thank the chairman. Appreciate you holding this hearing to assess what progress we've made under the Jobs Act, clearly one of the most important and successful fiscal economic policy acts passed during the Obama days. I'd like to start out, we've talked a lot about costs of being a public company and the challenges of being public because of those costs and the immense size of market cap one has to have to really kind of justify going public and the frustrations of that. And some of that's 404 related, for example, and hardcore accounting costs, but I want to talk a minute and get people's views on the proxy process and sort of the challenges of being a public enterprise. 14A8, for example, on proxy access. And maybe start with you, Mr. Quadman. You referenced this in your testimony. It was meant to be a way for shareholders and management to communicate. That's why the commission organized it, and to have a two-way dialogue, if you will. But it's really become, in my view, as a former business guy, sort of taken over by various eccentric, occasionally volatile, activist-type topics, and can be very distracting to corporate management, not just on annual meeting day, but as a general matter. maybe driving up the costs involved in being public, but maybe driving down the desire to be public because it just is a distraction from the core business. You talked a little bit about a policy that the incoming commission might consider withdrawing staff legal bulletin 14HCF. Would you comment a little bit more on that topic?
Sure. So we have, and actually to give you, I guess, both sides of the coin there. One is 92% of CEOs in the IPO task force said that the burdens, that the reporting regime is very burdensome and it doesn't allow for them to provide information in a constructive way to investors. Stanford University did a study 2 years ago where they surveyed institutional investors with $17 trillion in assets. What those institutional investors came back with and said is the proxy is too long, it doesn't provide information, and only the third of the information is relevant. Furthermore, when we were putting together a disclosure effectiveness report a couple of years ago, and this is anecdotal, we came up with, everybody sort of thought that about half of the proxy was repetitive for legal reasons, for liability reasons. And somebody actually went back and ran some numbers through Edgar, and it came out to be about a third. So that it just, all that sort of encapsulates that information, or those information delivery devices are not providing decision useful information to, to investors. And unfortunately, the SEC as well, and this is why, also with what you raised there, the SEC has not been acting as the arbiter that they should be, where they're being the umpire here. So, as an example, with the Whole Foods decision, Mary Jo White issued it on a Friday night and effectively abdicated the SEC's role to be able to act as the arbiter for what proposals should be going forward or not either. So the system is broken and neither side sees it working.
Thanks, Mr. Quabbin. I want to switch gears just with the time remaining, and one of the issues I've been most interested in is can we make progress on crowdfunding? I introduced a bill that exempts crowdfunding from the burdens of Subchapter S filing for the IRS code as a way to encourage people to use the Subchapter S technique. What is the panel, start with you, maybe Mr. Knight, what problems have you identified with the SEC's final crowdfunding rule? And then we've probably got time for one other person, if you'd respond to that. What can we do to make it better?
Well, obviously, because there has not been the public response that people expected, that it needs to be revisited. And I just think from the outset, the SEC's view of it was that they were not for this, and they made it, shall I say, needlessly complicated, and did not approach it except as this was something where the public is going to get harmed, and we need to narrow it as much as possible.
Thanks for that. Following my time remaining, Mr. Chairman, I just would say to Mr. Hahn, I think you referenced IPRs under the patent law in your short selling testimony, and I think potentially this is there's abusive use of IPRs, and I hope that Mr. Clayton, once he gets his team in place at the SEC, will look at this. I've heard about specific concerns in the district about that issue, so I appreciate you raising that. And with that, I'll yield back, Mr. Chairman.
The gentleman's time has expired. And just for information, votes have been called, have been called. So what I'd like to do is go to Mr. Scott for his 5 minutes, and then we'll need to break, and hopefully everybody can stick around if that's all right. We anticipate walk off the floor at about 3:50, and so I'd ask everybody to get back here as soon as they possibly could, as a courtesy to our guests, so our witnesses. So with that, Mr. Scott, for 5 minutes.
Well, thank you, Mr. Chairman, for squeezing me in before the bell. Appreciate that. Let me ask you, each of you, if you could respond, if you could change one thing about the Jobs Act, what would it be? And as you're pondering that, do you think the Jobs Act went too far in loosening security regulations? And if so, why? And I understand that some of you certainly want to make it easier for businesses to raise capital or for entrepreneurs to start that new company, and so do I. But maybe this is just me speculating, that's why I wanted to find out, do you think we went too far with these regulations? What do we need to do with that? Mr. Green, maybe you can start.
If I could squeeze two, and it would be Title II general solicitation with the exception of the crowdfunding aspects of it.
You said general too?
Title II general solicitation and also Title V, I remember correctly, the one that took it from 500 to 2,000 shareholders, because I actually think that works against our desire to have a more robust public market by making it much easier for companies to stay big and private for much longer.
Okay. Mr. Hahn? What would you change?
I think targeted bipartisan acts like the Fostering Innovation Act, this one-size-fits-all regulation that, I appreciate some of these large companies, but I'm a very small biotech, so a lot of the regulations that large companies have to adhere to, I don't think that same one-size-fits-all is appropriate for a company of my size.
All right. Mr. Knight, what about you?
I think extending the confidential filing and testing the water provisions to all companies would be a positive development. And I don't think the Jobs Act went too far.
Good, good. This is what I wanted to hear. Yeah,
Mr. Scott, I think one is I agree with Mr. Knight that, the Jobs Act could have removed more obstacles, but I think more importantly, Title I was self-effectuating, the other titles in the Jobs Act were not, and that allowed a hostile SEC to either draw out the implementation of the Jobs Act or, in fact, blunt its effectiveness.
Mr. Keating.
I certainly don't think that it went too far. I think I mentioned raising the amount that a company can seek in a 12-month period would be a good thing. And one quick comment. I'm on board with all of the comments that we've talked about in terms of the problems of going public versus staying private. But when you look at Title III in particular and what we're talking about with crowdfunding, we're talking about the decision really of should I partake in entrepreneurship? Should I start up and build a business or no? And that's a very fundamental question that I appreciate that was addressed in the Jobs Act.
Good. Well, I wanted to, Mr. Green, right quick. I got another point.
To supplement by saying one of the things that I think the Jobs Act doesn't do is it doesn't do things other than deregulation. I think that deregulation has very limited and frankly a lot of negative implications or very limited impacts on increasing access to capital. We did a report at CAP that looked at minority and women-owned businesses and the challenges for them in terms of access to capital, and it's really the wealth gap. The average middle-class family saw their wealth decline by 49% between 2001 and 2010, and it's only recovered a little bit. We need to do other programs to boost that.
Right. Let me ask you this, because if you follow this committee, I've been very concerned about jobs, unemployment, all of that. And while I got this brain trust before me, how do we put more emphasis on this other feature of our economy that's moving so fast that has an impact on the joblessness rate? What I'm talking about is this rapid expansion of technology. Technology is being driven so fast that it's eliminating jobs. And I don't think we're all grabbing this as quickly as we could. I mean, there are jobs now that we once had, we no longer have because of automation. I always use the example about the elevator guy or, examples. What do you think? Are we doing enough to call attention to it?
One of the things that we noted was that there is a misalignment between the interests of the corporations and the public interest. And we just took the issue of workforce training, which is so essential to grappling with that. And we found that if we increased the disclosure of workforce training, made it more like R&D, you'd actually incentivize companies to invest in their workforce, to be able to respond to these new emerging technologies and changes. And it's those types of expanded disclosure that's so important to making the economy work for everyone long term.
It's so true in manufacturing now. We got the robots doing jobs that we used to do. I mean, it's thousands and thousands. Thank you, Mr. Chairman.
Gentleman's time has expired. All right, with that, I will just remind everybody, we are going to go and vote and then get back here as soon as we possibly can after votes. And with that, the committee is in recess. The committee will reconvene, and appreciate the patience of our witnesses. Thank you very much for that. With that, the chair will recognize Mr. Emmer for 5 minutes.
Thank you. Thanks to the chairman and the ranking member for having this hearing and examining the Jobs Act and how successful it's been and things that need to happen yet. I want to thank the panel for being here, and like the chairman, thanks for your patience. This place, it just never stops moving. Thank you for waiting. Very quickly, I come from the great state of Minnesota, where we still are home to 17 Fortune 500 companies, and agriculture and manufacturing drive our state's private economy. But Minnesota, like other states in the union, I suspect, it's imperative that we are constantly starting new businesses, because today's big business was yesterday's startup. The Kaufman Index is a publication that comes out and ranks states based on new startups. 2014, Minnesota, again, a state with some very serious economic activity, we ranked number 44 on the Kaufman Index in terms of new business startups in this country. In 2015, we dropped to number 47. In the most recent rating, we really haven't moved much. We're still in that mid to low 40s range for new business startups. And this is a state that's full of innovators and a highly educated workforce, many things going for us. So what's the problem? Well, we look around and we see that it's access to capital. It's access to capital and that is so necessary to start up these new businesses. That's why, in the short time that I have a couple of questions related to accessing capital and what maybe we could do more to hopefully enhance what the Jobs Act started. Mr. Quadman, in your testimony today, you talk about the need to fix the current rules regarding crowdfunding and to make them, quote, workable for businesses and their investors. You, I believe, mentioned, at least in your written testimony, Representative McHenry's legislation, as well as a bill that I offered in the last Congress called the Micro Offering Safe Harbor Act, as two steps that would be in the right direction. Can you please explain in more detail on the record today how these bills would help to provide early-stage companies access to the capital they so dearly need?
Yes, thank you, Congressman, for that question. In fact, the head of the Minnesota State Chamber is a former colleague of mine at the Chamber, so have spoken, so I understand the issues there. One of the things that we've found consistently, we've gone around the country doing different events with state and local chambers, is that there's been a disconnect between Main Street businesses and their traditional forms of financing. So they've been cut off from community banks for a variety of different reasons and other forms of financing. And this is a point I was making with in my answer to Ranking Member Maloney before, is what the Jobs Act does, and I think what you're trying to do with your bill, and I think what Mr. McHenry's trying to do to make crowdfunding more efficient, is let's create different options that allow those Main Street businesses to access different alternative means of funding, and let's create some new ones, and let's see what works and what doesn't. I think also to Mr. Himes's point, we've also asked the SEC, as they're putting rules together in each of these, that they do a post-implementation study, both to check on what the how investor protection is working, and also how the economics is working. So I think your bill is very important to do. I think we need to restore that access to funding to actually get the entrepreneurial machine going again.
And thank you for adding that on the SEC, because that was going to be one of my questions. What can the SEC do better? Why don't I move on with the short time I've got left? Mr. Keating, in your written testimony, you indicate that despite significant and positive changes created by the Jobs Act, there's still need for improvement. And again, back to this crowdfunding, you said in particular with respect to crowdfunding opportunities. Could you please describe some specific changes that you would suggest in the crowdfunding regulations? What should be implemented to maximize the ability of companies to raise capital through that process?
Sure, and real quick, in as a background to that, first off, on our Small Business Policy Index, Minnesota ranks very poorly. So there's a whole host of issues, I think, in the state in terms of taxes and regulations that need to be dealt with. But when you look at the financing issue, community banking, earlier somebody mentioned that community banks were using the Jobs Act. That's encouraging because community banks, they're small banks suffered the greatest declines over since 2007. So the large banks essentially remain steady, the number of them. The small banks is where we saw a collapse. A Federal Reserve report said that also there was an unprecedented decline in new bank entry. So we don't have that replacement going on, new banks coming into the marketplace. So these are all critical issues that actually have to be dealt with on that side. But then in terms of the Jobs Act, as I said, raising the level that companies can go out and raise in Title III funding, for example, would be good. Raising the limits that investors can put into these companies would be positive. And in our written testimony, we listed a whole host of areas where just those costs, the costs are still significant to go through this process. I think it was David Burton at the Heritage Institute, Heritage Foundation that did a study not too long ago talking about, when you look at the total costs of crowdfunding, it's a significant percentage of what you raise. And obviously, the smaller you are, the greater those costs are. So anything in terms of lightening those requirements, those regulatory burdens would go a long way to help.
Thank you very much. I see my time's expired, Mr. Chair.
With that, the chair will recognize Mr. Hollingsworth for 5 minutes.
Hi, good afternoon. Thanks so much for being here. Really appreciate all the testimony this afternoon and bearing the indulgence of a brief recess as well. My question's for Mr. Hahn. Tell me a little bit about some of the cures you're working on. What are some of the ailments you're working on to cure in the business?
I'm sorry, some of the
ailments, some of these illnesses, some of the challenges that you're working on cures for.
So our lead asset is in a phase 3 right now for vaso-occlusive crisis for sickle cell disease. Our next compound that we brought in the clinic is for acute myeloid leukemia. Yeah. We also have a trial in multiple myeloma.
Most of those are certainly words that I probably couldn't even spell, frankly. So I'm glad that you're working on them and not me. And one of the big questions I continue to ask myself is how we get capital in the hands of people who know how to innovate and develop new products, far beyond my meager comprehension. And I think one of the things that I introduced along with Representative Sinema across the aisle is the Fostering Innovation Act that you had mentioned earlier today, and how we enable and empower you to be able to devote more of your resources to science, as you say, and not compliance. And so I continue to be a big champion for that innovation. Tell me a little bit about what the cost of complying with a 404B audit might be, both internally and as well as the check you might have to write to an accounting firm to verify that.
So first, thank you for sponsoring that Fostering Innovation Act. So to comply with 404B, we're looking upwards of $350,000. So our external auditors have given me a number, $150,000 to $200,000. Right now, we do have an outside firm that is auditing our internal controls. Those costs would increase up to $100,000 and up to about $100,000 in internal costs, whether it's personnel or other internal related costs. When you first think about a $350,000 to $400,000 number, it's hard to believe at first, but if you take a step back and look, the last year, our external audit fees, the last year we were private, we paid just under $50,000. Mm-hmm. In 2016, we paid $567,000 alone just to our external auditors. And that goes back to an earlier comment about the cost of just being public for us is about $1.8 to $2 million in just the between the lawyers, insurance, auditors, and reporting requirements.
Right. And to the best of your understanding with regard to the Fostering Innovation Act, there's nothing in here that says you absolutely cannot engage in a 404B if you, as a company, deem that it was necessary to do so, that you wanted to lower your cost of equity, of raising equity and follow-ons, et cetera, or investors pressured you to do so. You could still go through a 404B, but it would be a business decision, not a regulator decision, right?
Correct. It's optional. And as with growing companies, it's what makes sense. Right. You know, our 1231 financial statements, 95% of the assets on our balance sheet were cash. Right. So it doesn't make sense to me to talk to investors. You know, they want all of the money they invest to go toward the science, toward the clinical trials, to get these therapies to market. And to sit there and tell them 350,000 just to, make sure our bank reconciliations and the cash confirmations, just to go an extra layer there, the cost-benefit ratio just doesn't make sense. Same thing, we do 125 checks a month, and the CEO and I are still the only check signers in the company.
Right.
So we still have good controls around the cash disbursements.
Right. And certainly, biotech is a risky space. It's challenging to develop these new drugs, these new medical devices, et cetera. And so it's certainly risky, and some of those companies do fail. Either the products didn't work or they were unable to get the products that they thought they would when they first raised capital. But that doesn't mean that we shouldn't lower the regulatory burden for the many companies that are trying to succeed and bring drugs to the market. And so I certainly appreciate you being here and appreciate your testimony on behalf of the Fostering Innovation Act. And with that, I yield back.
Gentleman yields back. With that, the chair recognizes a gentleman from New Jersey, Mr. MacArthur, for 5 minutes.
Thank you, Mr. Chairman. This is kind of like coming back from a rain delay in a ball game. You have to get back into the swing of it. And I'm reminding myself of a few things that we were talking about before the recess, and I just want to explore them. Mr. Quadman, you represent a host of different kinds of companies, different sizes, very different capital structures. And just briefly, because I've only got a few moments, would you just remind us what are the reasons for and the benefits of companies using a public market capital structure?
Yes. The traditional form of businesses was to go public. I mean, that was always the goal, and the reason for that is that you can acquire, or traditionally you could have acquired an amount of capital that you normally could not have. So if you were a rapidly expanding business, that allowed you to access those capital markets. What has shifted in the last 20 years, I think there are two shifts. One is there's more of a desire to remain private, partially because of some of the rules that the SEC imposes on you, and a fear of, particularly amongst founders, of losing control. The second is that there's been a fundamental shift in mindset as well. I spoke before, a few years ago, the top 100 entrepreneurs under 30, and I asked them the question, do you want to go public, remain private, or be acquired? And it broke out a third, a third, and a third. I asked that question about 10, 15 years ago. It would have been 95 wanted to go public.
So, and I think that's been my experience too. I was a lifelong businessman, and as I was thinking about your 4 reasons why you think companies aren't going public, they were sort of environmentally structural issues, the way the markets work, and I jotted them down. You mentioned structural and managerial issues at the SEC, financial hurdles, the regulatory environment, the disclosure regime. It got me thinking about, I hit a tipping point in my business, right around that number you mentioned, $100 million in revenue, and I was growing rapidly, needed to grow more rapidly, needed capital, and I had to assess how to get it.
Yep.
And I wanted to go public. Actually, I was one of those 15 years ago, 90%ers who thought that would be an interesting way to evolve the company. I chose to go in a different direction, private equity. I know why I did. I'll keep that to myself for a moment. But I'm curious why you think, and Mr. Knight, feel free to weigh into, why do you think companies are choosing, beyond the things you've already mentioned, to avoid the public markets?
Let me give you one very small example, but then you start to multiply this out, as I think one of the issues I was talking about in terms of the disclosure regime. Pay ratio, right? So Congress decides companies now have to publish a pay ratio between what the median average worker's compensation is worldwide versus a CEO. So some people look at that, well, that's sort of an innocuous thing or whatever. Courts have recently started holding, though, that disclosures like that are really intended to embarrass companies and they violate the First Amendment. But now look at what's also happening. You now have jurisdictions that are passing a pay ratio tax in Portland, Oregon. You have others that are looking at it. You sort of look at the progression of the soda tax. This is where it's going. So when you start to multiply that out by hundreds, people look at it that those burdens are no longer necessary. You don't want to go through those in order to have to be public, and that's what Michael Dell, why he decided to go private.
So it sounds like you're really saying that becoming public seems to create an opportunity for the same size company it was before, same quality, same business, serving the same customers with the same employees. Being public now means it's an opportunity to have other people exercising a good deal of control and influence and
Control and influence
embarrassment
and injection of political agendas which have nothing to do with running the business.
Mr. Knight, just briefly, do you think we have evolved into a place where failure and bad management seems to have been criminalized?
You please push your mic.
I don't think I'd say criminalized, but I think the markets don't seem welcoming to entrepreneurs, the public markets, and they have alternatives in the private markets. But look at a company like Tesla, Elon Musk. He is investing for the long term. He wants to take us to Mars. You cannot do that in a few months or in a quarter. So the markets aren't designed today to accommodate that kind of vision. The private markets do have funding available, but the public market, they won't always have it, and they're not for everyone. The private markets aren't suited, for instance, to many things in the healthcare area.
My time has expired, but that, by the way, is probably the leading reason for me. I didn't want to live under a quarterly microscope. I had plans that were going to take some years to evolve, and they did evolve. But I thank you all for your testimony today.
Gentleman's time has expired. We are, with the permission of our witnesses here, we're going to do a quick second round and go to our ranking member, Ms. Maloney, for 5 minutes.
Thank you. First of all, I'd like to thank you, Mr. Quadman, for the Chamber supporting my legislation on just disclosing the number of women that are on boards. And recently, a statue appeared in the middle of the night in the middle of Wall Street with a little girl demanding the same thing. And it just took off in social media with great thunder. I would like to ask you and Mr. Knight and Mr. Green and anyone who'd like to comment that first of all, do you think the definition of accredited investor needs to be revisited? In '82, an accredited investor was required to have $1 million in assets or $200,000 in annual income. Now it's over 30 years later, and it's still the same definition. Should we update that and change that? And secondly, a common theme that we've seen in this committee's capital markets bills is promoting capital formation by eliminating or weakening investor protections. But it's important to remember that investors are the ones who contribute, and if they don't think it's fair, they're not going to invest or they're going to require a higher return. The Council on Institutional Investors, they are very strongly in support of the principle of one share, one vote for public companies. They see this as particularly important. Yet, as we saw earlier this month, Snap Inc. went public with shares with 0 voting rights. And could you discuss the problems with permitting lower standards for investors among public companies, particularly from a U.S. competitiveness perspective? And if anybody would like to comment on Basel III and whether you think that is fair to American companies and American banks. Anyway, just a few ideas. If you have any comments on them, I'd like to hear them from anybody on the panel, but I'd start with the Chamber, which is so active in the district I represent.
Thank you, Ranking Member, and also enjoyed working with you in a previous life in the 9/11 Health Bill as well.
Thank you.
Let me take those 3 things as well. So one is with accredited investors, I think we need to look at the definition of accredited investors and who can be an accredited investor. I think Mr. Schweikert, during his time here, did a lot of thinking on that, and I think looking at the expertise of an individual and is necessary, I think, to do that. And if we take a look at where the courts have held what the investment decision-making process is, both in the TSC case and BASIC and their progeny, I think that is something for us to look at. With Basel III, creates different restrictions on our banks in that banks are no longer acting like banks. So as an example, under Basel III rules, it is a disincentive for a bank to take business deposits. That's exactly why banking in the Western world started since the Renaissance. What was the second question?
Well, the whole thing about Snap Inc.
Yes.
That it went public with
What I
zero.
would say there is we have to remember that corporate governance ultimately is an outgrowth of state corporate law. And that has allowed for a diversity of different structures and different businesses and the like. And investors can pick and choose exactly where they want to invest. So if they don't like that class share whatever that Snap has, they don't have to invest in that company. So I think we are trying to drive towards a one-size-fits-all system, and that's exactly where I think the public company model is breaking down. And if we allow for a diverse system that allows for investors to make choices, let them make those choices, and we'll also have market-based solutions.
Okay. Would anyone else like to comment on any of those?
I would agree with Tom, but highlight also that the flexibility in the capital structure that we allow in the United States, I think is perfectly suited for our culture and society and laws, and one of our strengths, which is the ability to attract entrepreneurs to our shores, to grow entrepreneurs in the United States. People, again, like Elon Musk or Steve Jobs, and people want to invest in these entrepreneurs. So creating a capital structure where you have the choice to invest in those entrepreneurs, I think is uniquely American and something we ought to preserve. We're not forcing anyone to invest in these companies.
If I could add a few thoughts. I'm very concerned about the trend away from one share, one vote. I think there is a growing problem in this country of concentration of economic power. We see it in insufficient antitrust enforcement. We see it in market concentration. It's the number one reason we are losing public companies is we don't have sufficient competition. And I actually see this problem of corporate governance in terms of moving away from basic shareholder accountability, that's capitalism, as being a major risk to the vibrancy of our capital markets and fundamentally to the way our capitalist system works, which is empowering shareholders and investors to make good decisions about where to allocate capital over the long run. If I could just very briefly add two more thoughts, I'd like to commend the SEC for very recently putting out proposed new Guide 3 disclosure guidance for bank holding companies. This is a very important update, and Acting Chair Pivovar and Commissioner Stein have made good progress on that. And so that's somewhat responsive to the question about Basel III. I think we need to complement our capital rules with much greater disclosure so that investors have an understanding of what our big banks are doing. Are they investing in the real economy and in the business that need it, or are they engaged in trading and other activities that, although somewhat important, are not their core function?
Thank you.
Gentlelady's time has expired. I will take my 5 minutes, and I'm actually curious, Mr. Knight, if you could comment on what Mr. Green had just talked about. I too am concerned about a concentration of wealth in vis-a-vis that people are not having the opportunity to catch the upside of growth. And I think that was what your chart number 1 was exactly trying to address. It seems that this, it seemed to me that, though, continuing to add more additional regulation, chasing people away from an IPO is actually maybe compounding what Mr. Green was just talking about. But have you comment too? But
early stage, high growth companies, ideally, retail investors can participate in the growth phase of those companies. My mother paid for my law school education by investing in a local company. That type of story doesn't happen very often today. If you put your savings in a savings account, you'll get 1 or 2%.
I'd like to know where you're going to get that 1 or 2%.
If you're lucky.
Quantitative easing is taking care of that.
Funding education today, how are people going to do it? One way to do it, of course, is by investing in early stage companies. These companies, the rules, the market structure are not attractive for them, and they have other choices. without sacrificing investor protection, I think you can make these markets more attractive.
Yeah, Mr. Green, real briefly.
If I could suggest just, though, that some of the innovations in the Jobs Act, like Title III crowdfunding, like Title II crowdfunding, if there are ways to make it at very small levels available, those are exciting things that we should see if they're working out and provide greater opportunities. But I think we also have to be very much aware that a lot of small companies fail. And given the collapse in wealth and middle class in this country, we just need to be very aware of that.
Sure, but that's the risk and reward of a free market. Mr. Keating.
Yeah, I'm not worried about wealth concentration. I'm worried about wealth creation, and I want to see widespread wealth creation, and that's why I was so excited when the Jobs Act passed, because that's another avenue for entrepreneurship to flourish. When entrepreneurship flourishes, entrepreneurs create wealth, they create jobs, they invest in technologies. We heard about technology earlier today. Technology improves productivity. Higher productivity means higher incomes. That's the wonders of the free market. And if we get our regulatory structure right and our tax structure right, we can unleash some great things in this country, I think, once again.
Right. Mr. Hahn, I've got a quick question for you. To the extent that XBRL tagging may be of some use to small companies, do the benefits for companies outweigh the cost at this point, particularly for smaller public companies with fewer resources? And I'm curious if you can comment on that.
So we support the Small Company Disclosure Simplification Act targeting the XBRL. We spend upwards of $75,000 a year for the XBRL. That, again, the cost-benefit ratio right now for our size company, it's just not a benefit for us.
Okay, and I believe that was Mr. Hurt's bill from last Congress, and that is part of Choice Act as we're looking at it. And then I guess I'll close with this and the remaining.
Then may I make a last question on XBRL?
I'll yield to the gentlelady.
Okay. I just want to share, the former Secretary of Treasury, Jack Lew, the financial crisis started in America, yet we rebounded faster than the rest of the world. And the reason he gave, I thought he'd give the usual, it's our private sector so innovative. It was the amount of new things that not only the private sector did, but government did. We just kept trying one thing after another, and if it worked, we kept it. If it didn't, we dropped it. And he attributed that to why we came back so fast. But on XBRL, it became a debate among some of us on this committee that it may not be as beneficial to small companies as to large companies. But I personally think it's extremely beneficial to small companies, and my question is, does this make sense? Investors, to have to do the research to figure out where to invest, they'll go to the big companies because it's out there, it's tested. But if you had an easy way that they could access information, which is what XBRL would give you, they'd be able to make a comparison between companies with innovation, ideas, which, Mr. Knight, you just mentioned, the one area we lead the world in from the beginning of our country is entrepreneurship. That's the one thing that we do brilliantly and so much better than practically all the other countries combined. But it seems to me, as a small investor, to be able to compare the data that's accurate, assuming it's accurate, then you could see a trend or an idea or an innovation or a management team that was standing out. And it seems like it would help small companies because oftentimes investors don't have the time to read through the big investor portfolios, much less the small investor portfolios. So my friend Hurt, whom I miss because he retired, but we had many conversations because I would argue with him that in my opinion, as a small investor, the XBRL to smaller companies would increase the flow of money going to smaller companies. I represent a large investment community, and they tell me that they'd love that data. These angel investors, they're constantly looking for the next new ideas. And I'd like to ask that question because this is an issue before the committee that the chairman pointed out. So anybody want to comment?
And reclaiming my time.
Sure.
Go ahead, Mr. Quadman.
Sure.
And I think the point of my question was, though, the cost. I mean, if it's costing $75,000 a year to a small company, I understand how an angel investor would love to have standardized information at no cost to them. It's the cost to that business owner. So maybe, Mr. Hahn, have you just answer that, and we'll go to Mr. Quadman.
I think from our company, from Glycomimetics, a biotech company, more emphasis is put on the actual science, the actual technology, more of the scientific publications. We have ASH in December, EHA in June, and I think most of our investors dig into the scientific aspects of it. The angel investors aren't really the ones that we see conversations with. The amount of money, capital that we need to raise on any given round, we're talking 20, 30, 40, $50 million. It's the large institutional investors who have the MDs, the PhDs on staff that dig in to understand the science. So, I understand from being able to see the data, but in all of our investor meetings, it's always about the science and about, what does the data show? What are the risks around the data? Not necessarily the overall details in all the filings.
We're a bit over time, but Mr. Quadman, if you could maybe really quickly address sort of this disproportionate burden that may be hitting small businesses.
So just a short-term and a medium-range answer. I agree with Mr. Hahn. One is there's a Columbia University study that less than 10% of investors use XBRL. So in that way, it is not an effective delivery device for investors to get information. The second little longer-term answer, and this actually goes to Mr. Scott's point about technological changes, companies are looking at blockchain for settling. If you have companies connected through blockchain on a common electronic ledger, XBRL is out of date. That has a real-time component for corporate disclosures and financial reporting. That's what the SEC should be looking at. So I think technology is outstripping this question, actually.
Okay. And my time is well over, but with that, I will recognize the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Mr. Chairman, thank you very much, and thank you all very much for your testimony and the time that you spent here before the subcommittee. It's an honor to just participate in this dialogue, and one of the questions that I had is, with the propagation of exchanges that are out there, how is that affecting small capital, whether it's venture-backed or private companies looking to become public companies? I won't ask anything further to kind of lead the angle, but just curious how you see that affecting small capital.
If I could, the purpose of the statutes that created public stock exchanges is to create price discovery. With clear price discovery, you attract liquidity. When you fragment that price discovery across 11 stock exchanges and 40 dark pools, that might work for Google, for Apple in trading. There's enough liquidity there that the price discovery process goes forward. But for a company that is a market cap of less than $50 million, it means the price discovery process breaks down and makes it more difficult for large institutions to invest and makes the public company model less attractive. And that's why we have said that market structure has a cost associated with it. The SEC's approach, although thoughtful, has not kept up with the needs of the marketplace, and they take a one-size-fits-all approach. We think there needs to be more flexibility, and that was an idea that was also part of the venture market legislation that was introduced last year that we support.
Thanks. Does that speak for everyone? Same kind of observations?
To be honest, I'd have to think about it some more.
Okay. Yeah, that's my main question. I think all the others have really been asked, pretty extensively. But I think one of the other key takeaways that I have on not so much public companies, but maybe you could give some thought to it, is there's a large space between bank debt and mezz financing. And do you see anything out there that bridges that gap? do the market rules basically crowd that out? Are there regulations that you see as helpful to creating some gap between the cost of capital in the bank debt world, and then you have a, I don't know, 9% plus spread between bank debt financing and mezz financing for most markets, which is a pretty big spread.
Yeah, if I can answer it, and this relates back to my answer also with Ranking Member Maloney of Basel III. A lot of the Basel III capital rules are making banks recede from giving business loans. So therefore, we're seeing alternative means of financing grow up or sort of become attractive. This is why I was mentioning before the legislation regarding business development corporations, making them a more active participant is something that can help fill that space. So I think unless the capital rules start to change and the risk weights start to change under Basel III, we're going to have to look at these other alternative means of financing to help bridge that gap.
All right, thanks. I yield back.
Well, actually, will the gentleman yield to the ranking member has a question?
I'm incredibly interested in
I think your mic needs to be.
and we'll ask the chairman if he would have a hearing on it. I hear from some banks that they feel like it's imposed on them, but it's not imposed on other banks around the world. In other words, we have very tough regulation. I think that's one of the reasons people like to invest in our markets. They trust them more. But on the other hand, they feel like they're held to a higher standard with capital requirements that puts them at a disadvantage. But I am fascinated with the fact that Basel III is discouraging two of the main functions that the banking system was created for, taking deposits and making business loans. And now I understand for the first time why some of my constituents who are extremely profitable can't get business loans. So this is really bad. If we want to talk about getting capital out for entrepreneurs and businesses, it's figuring out why in the world would Basel III discourage business loans? It makes no sense. That was the main reason for banks to get out and help start financing homes and financing businesses. So could you comment or somebody on it? I mean, I'm shocked at this.
What Basel III does is, it's looked at in two different ways, right? Remember, it's supposed to be an international standard. However, European banking regulators look at it as a ceiling. American banking regulators look at it as a floor. So traditionally, American banking regulators make it very tough. The other thing it does is it creates an incredibly complex and intricate set of risk weights that investors don't understand what they're looking at. And what that does is it creates perverse sets of incentives and disincentives for activities for banks to undertake. And frankly, you get to a point where some banks, some of the larger banks, have global presence, can work around those rules and adjust their activities accordingly. But when you start to get into the regional banks, including the Dodd-Frank systemic risk thresholds, they suddenly have to start to recede from activities where they are, in fact, the primary liquidity provider for regions in the country. So that is what has caused this disconnection between financing and Main Street businesses.
Well, what I don't understand is, if you're a regional bank and a community bank, why are you being held to international banking standards? Because they're not involved in international banking.
That's a question we've asked as well.
Yes, and one we'll continue to ask. So, with that, I appreciate our witnesses. We feel we had a great hearing today. And without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. And I ask our witnesses to please respond as promptly as you're able to. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, again, thank you, gentlemen, for your time and your patience as we had to break, and our hearing is adjourned.